Hi, everyone. My name is Orlando Duke, and I'm a loan officer with Premier America Credit Union. Today, I'm going to talk about some creative ways that I can share that I've seen in the past how someone might be able to use some of these strategies to save towards their future home purchase. I want to start by saying a lot of ways that you can get started in saving for your home purchase is creating a budget and making sure that you're trimming some of the fat, like subscription services that you have that aren't being used on a monthly basis, shopping around for the services you're currently using, kind of like your banking and financial services. So I wanted to start with the first advice with sharing a little bit about what credit unions are. And credit unions are a financial service institution who actually is owned by its members. So if you open an account there or you have a loan with the credit union, typically you own a share of the credit union. So that credit union at the end of the year doesn't pay taxes on that income that it earned as a financial service institution because all that income is actually reinvested back to its members. So our members will benefit from lower fees, lower rates on loans, higher rates on savings, just by the simple fact that we are a credit union. So we offer the same benefits as any big bank, all the services available. We just tend to be competitive in a lot of those areas because of our structure as a non-for-profit credit union. There's a lot of them out there. I recommend all of them. They're all really great. Some of them will have some restrictions in how you can join. You either have to work for a certain employer or live in a certain area. And a lot of them are actually open to the public. So that's my advice. Number one is I invite you to make sure you're not paying any fees on your accounts. If you're paying any high overdraft fees, any monthly checking fees, if you have high rates on your current loans like credit cards, auto loans, that's definitely one way that you can start saving and apply those savings towards your future home purchase. So I also want to mention today, I am a loan officer. I am not licensed to give any tax advice or any investment advice, but I will be sharing some strategies today that, again, I've seen in the past. And really the meat and potatoes of what I want to share today is not only do you need a good loan officer to guide you in how to obtain that loan, how to qualify for a loan, but you also have a little bit more strength in your future goals if you have the right team in place. So some of the recommendations I have today is having a team of a good insurance broker, making sure you're also for your car, for any assets that you have insured, you're getting the best service and the best price for those insurances. I also really recommend, even if you're starting really early, having a good financial advisor to help set up a plan, set up maybe some alternative investments instead of parking your money in a savings account. Maybe there's other investment vehicles that you can park that money while you're saving towards that future home investment. So one of the things I wanted to also share with a creative strategy on how to save money for your future home purchase, a lot of people who are currently employed have a retirement account called a 401k. They're able to deposit into this type investment account that's money set aside for retirement. That money is typically invested in the stock market. So there's a little bit of risk. You can choose what kind of risk you want to take, what kind of returns you're looking for. So again, a financial advisor or your 401k company would be a good step to talk about these type of accounts. Make sure you're taking full advantage, especially if you are employed and you have an employer who's matching your contributions anywhere from 3 to 5%. That's just money on the table that you want to make sure you're taking advantage of. Now, the reason I wanted to bring up 401ks today as a creative strategy towards saving, towards a home purchase, is because the 401k companies actually have a nice benefit that you could either borrow or withdraw from these 401ks. They have their rules, so you want to make sure every 401k, every employer is a little bit different. So today I'm just going to give an overview, but in no way am I giving specifics. What I'm inviting you to do is to call your 401k company, call a financial advisor, and get the details of your specific plan. But as a whole, what I've seen typically is that you can borrow from your 401k. So what the huge benefit is that you're putting money away every paycheck and you decide what percentage you want. So if you're saving towards a home, you want to make sure that it's pretty aggressive how much you're putting aside. I recommend at least 10%, because it's going to give you the opportunity to not only see how much you saved in 2 years, but almost budget around it. So the fact that the money's already being taken out of your paycheck, you've learned to budget what's left over after that paycheck. But sometimes what we do is we get that paycheck, we pay our bills, and then hopefully there's something left over for yourself. With this 401k, it forces you to pay yourself first, pay into your retirement, and it gives you an opportunity up to a certain amount where you can withdraw or take a loan. And it's almost like you're borrowing from yourself, borrowing from this money that you have invested, and you could use that towards a home purchase. There's on withdrawals, there's benefits of not paying penalties for the withdrawal. Since you were putting that money aside for retirement, but you were using it for a home purchase, you could provide proof of that purchase, and that 401k company can allow you to withdraw a certain amount without any penalties. Now, with the withdrawal, again, I'm not giving tax advice, but you want to also talk to a good tax preparer. Again, another person that needs to be on your team, and make sure that that withdrawal isn't going to impact your tax basis, because it is almost income for that year since you are withdrawing money from that 401k. The other side to it is the 401k isn't income. You're borrowing from yourself. Sometimes these 401k companies let you borrow just for a personal loan up to 5 years. Whereas if you can show you're doing it for a purchase for a home, these 401k companies will let you repay or borrow that money up to 15 years. So the loan, when it's paid back, they also take that from your paycheck. And if you get paid every 2 weeks or once a month, depending on how often you get paid, that payment is set aside to repay yourself into that 401k. Now, I like the 401k loan because I was able to invest money, deposit my paycheck pre-tax, since I set that money aside for retirement. I could borrow from myself. The rates are really low, really, really competitive. Again, you want to ask those details with your 401k company. But at the end of 15 years, once I've repaid my loan, I still have a home. I have a mortgage. I have equity in my home, and I've already repaid what I borrowed from myself, and the money's back into my retirement. So that's a great strategy I've used in the past. I see a lot of people use in the past. If you're not currently employed with a company who offers a 401k, let's say you're someone who's self-employed, you still want to talk to a financial advisor, to a tax preparer, and talk about accounts, individual retirement accounts that you can invest in every year, and use it for the same purpose of possibly withdrawing in the future for a future home purchase. Strategy number two, besides budgeting, saving on expenses that you can eliminate, also using your retirement funds, I also recommend that you pretend you have the mortgage today. So, for example, I always like to say in your home purchase plan, your biggest strength is the knowledge and the goals that you have, and knowing what it is that you need to meet those goals. So you would talk to a loan officer like myself. We would give you a guide on how much income versus how much of a loan you could afford. Also, some of the down payment requirements. There are some great programs out there that are no down payments. There's also 3% down programs. There's also 5% down programs. There's also 10 and 20% down programs. So the higher the down payment, where you're going to benefit, not only is your payment going to be lower because you're putting more money down, but as you reach each category, the loan actually gets cheaper. So the more money you put down, the better closing costs, the better interest rates you're going to get. Someone who puts nothing down will maybe qualify for the loan, but they're typically going to be paying higher fees, higher interest rate than someone versus 3% versus someone doing 5%. My advice is always plan to at least meet the goal of a minimum of 5% down. Even if you are able to buy with less, it's still good to have that cushion for home improvements, for emergencies. So after talking to someone like myself and developing that plan, one of the things that we're going to teach you is not only how much you qualify for, but what your mortgage payment's going to be, what the loan payment's going to be, what the PMI is going to be, the taxes, the insurance on that home. And what I invite you to do is get that information early. If it's a 6-month goal or a 12-month or a 24-month, 2-year goal, you want to get that information today and pretend like you have the mortgage today. A lot of us really want to continue to live a certain lifestyle and expect to change that lifestyle once you've obtained that mortgage. I invite you to do it today. So if you're currently paying $1,500 on rent, and after talking to someone like myself, you find, hey, I want to buy a condo that's similar to my apartment, you're probably not going to be paying $1,500 on a mortgage. Typically on a mortgage, it's going to be a little bit more than what you're paying in rent. But remember, you're paying your mortgage down every month $4,500. You're also getting a tax benefit at the end of the year, potentially for having that mortgage. So it's not really apples to apples you're comparing, it's apples and oranges. But once you find out what that mortgage payment is and you find out that it's $500 or $700 more than what you're paying in rent, that should be the absolute minimum number that you're putting away every month in savings. So if you're in a situation where you're living with family, your rent's really low, or you've been in an apartment for a long time and your rent is pretty low, you want to figure out what your mortgage payment would be if you buy what you're looking for, and make sure that you're setting that budget today. And whatever excess that you have, put that towards savings. You're going to find that you're going to meet your goal pretty fast with the amount of money that you're going to be putting away. Don't wait to buy that home to have the higher payment. Again, one of the things that you want to do is pay yourself first. Make sure that not only do you qualify based on your income and your credit that you've been working hard in obtaining, but also that you can commit to that payment early. And you might find that after a few months that payment's a little higher than what you expected. So even though a loan officer like me may say you qualify up to 2,000 a month, you might find that based on your personal budget and lifestyle, it's actually you want to keep it closer to 1,500 a month. So it's always good to start early, get this information so that you have time to prepare and see how that payment feels. Another bit of advice that I give is having a good driving record. We don't think of that as how important it is in our financials. You know, if you get in an accident or have not so good of a driving record, your expenses might be an extra 100, 200 a month alone on your car insurance, or even the interest rate that you pay on these loans. So I invite you to keep conservative with not only having a good driving record, but also keeping your car budget in mind for your future home purchase. Sometimes we could afford a little bit of a nicer car because we don't have that home. We expect that once we find that home, we could maybe downgrade the car or make changes at that time. It's one of those things, since it's a big, besides the home purchase, a car purchase is probably the next big purchase that we do in our financial life. I invite you to think about that early, before you, even a year or two before you buy the home, to consider that in your budget, because it can potentially impact how much of a home you could afford. Not only are you considering your budget in the car, but the insurance. So as I mentioned early on, one of the people that you have on your team, besides a loan officer, a realtor, a tax person, a financial advisor, you also want to have a good insurance person, an insurance agent who's going to make sure you're getting the best value and the best price on your insurances. And when you do go buy your home, that insurance person is going to help you get the best insurance on the home as well. So that's one of my creative tips, and making sure that you save towards your home. Speaking of cars, I wanted to touch on those few of us that have purchased a car, we've paid it off, and maybe you have a $20,000, $30,000 car that you've worked hard, you've paid it off, it's still worth some money. You obviously have the opportunity to sell that vehicle and make a profit if you don't have a loan on it, or you owe less than what it's worth. That's money there that you might have saved that you could use towards a home purchase. Now, you may go to a credit union, a local community credit union, and say, hey, I have this car paid off, or I have a car that I only owe 10,000 and it's worth 30, or it's worth 20, it's worth a lot more. The credit union could potentially look at maybe giving you a loan and taking some money out of that car. Now, depending on what your budget is, you want to make sure that you don't want to borrow too much on the car and it's not allowing you to qualify for that home price that you're looking for. But a lot of people, the issue isn't the income; they could afford the payment. They just work hard on paying off their car and other debts, and they didn't really get around or have enough time to save. But they see, hey, the rates are really good now. I want to take advantage. I don't want to wait another year to save. So look at your cars. Maybe you have equity there that you can actually borrow at a 3-4% fixed, and that's almost a way of borrowing from yourself, like you're borrowing from your retirement, borrowing from cars that you have paid off, to use that money towards a home purchase. Typically, you can't borrow money for a down payment. That has to come from yourself. But this is a little bit different because you're borrowing from something that you own. So you could actually show the credit union or your lender that yes, you took out a loan, but it wasn't a credit card. It wasn't money you borrowed from someone. It's actually money you borrowed from the value of your vehicle. So that's one creative strategy I've seen used in the past. Um, Also, where I'm going to end, my last creative strategy for those of us who live in expensive areas, which seems like most of the country today with home prices where they are, it almost seems like it's getting further and further out of reach. Especially in the Hispanic communities and in a lot of other communities, we have families that are really tight. And for example, for myself, I could have waited and saved up enough money for a down payment on my own, but for my first home purchase, I actually teamed up with my family. I had my mom, who was not a homeowner, my brothers were not homeowners. So instead of me having a goal by myself, I made a little bit of a compromise and said, hey, maybe we could do it together. So we all pitched in, we all saved money, and we were actually able to purchase our first home together. And yeah, it's your first home isn't the perfect home. Ideally, I would have wanted to have my dream house by myself, but since the family didn't own, it was nicer to be able to team up, do something together, share in our income, share in our credit, share in our down payment. And fast forward a few years later, we really fixed up the home. We really took care of the home. We made sure that the mortgage was paid on time. We were there for each other. We were living in the home, and we were able to sell that and each have our little nest egg or our down payment for our future home purchases. My mom went and purchased her own. I did my own, but it wouldn't have been possible without that first home purchase. So that's a creative strategy that I always invite. I have best friends who are also interested in buying properties. Sometimes I think, hey, if we find a good opportunity, I'm more than welcome to buy something with friends. Again, together you're able to do more. Um, Lastly, I wanted to add with as far as who can be on the loan application. Typically, you don't have a limit of one or two people. There's been families who there are six people on the mortgage because they're all going to live in that property. I just want to add that when you are applying together, typically you are applying based on living in the home together. So I wanted to add that. And of course, not only am I an advocate for my credit union, but I do invite you to shop your local credit union, see what programs they have available, what kind of savings accounts, what kind of programs they have, like automatic transfers from your paycheck into a savings. But remember, rule number one is don't wait to get close to that home purchase. Plan ahead and start, even if it's a little bit, but start early and make sure you're paying yourself first before everything else. Even if you need to cut one or two vacations a year, in the end of the day, it's going to be worth it once you get into that first home. So thank you for your time, and always feel free to reach out to me directly. You can find me online at premieramerica.com/Orlando. Thank you so much.